Hey everybody, this is Mike Finnen from Buttonwood Tutor. I am back for the third level, the third video that is covering the SIE. I'm trying to cover it as much as I can, soup to nuts. The only thing that I probably will be doing separately is I'll probably do an option video separately and a margin video because there is so little option and so little margin on the SIE that it's almost not worth doing. It's not worth spending a lot of time doing it anyway. So I try to avoid that. Also, if any of you need help tutoring, feel free to look at my website, buttonwoodtutor.com. I do private lessons. I can even set up study groups or whatever needs to be done. But right now, my main goal is to help you to pass this SIE. And by going over the SIE in great detail, hopefully that's going to get you where you need to be. And life can move on and you can be past all this stuff that most people can't stand. So right now, what we're going to talk about are market order types. The first order type and the most mentioned one becomes a market order. What is a market order? Buy 100 shares of XYZ at the market. That means you enter the order, the next trade, you are on the tape. Okay, whatever the price is for the next trade, you're going to get done. So it guarantees an execution. It is the fastest fill, but you're not guaranteed the price. Wherever the next trade happens that fits your criteria, which is basically anything, then you're going to get executed. Buy 100 shares of XYZ at the market, you put the order in, the next trade 17, you buy 100 shares of $17. Next, we have a limit order. What are limit orders? Limit orders are when, we have jobs, we have things we do, people want to talk to us to our market hours. So let's say we see a stock that we want to buy and it's trading at $40, but we don't want to pay $40, but we do want to pay 35, or say even want to pay 39.50. So we enter an order to buy 100 shares at below the market price is trading at 39.50, put it on the book, and then if it on a buy limit, if it trades at or below the price, it will execute the order. On a sell limit that's above the market, if it trades at or above, it trades I sell. It does not require a trigger. All it has to do is hit the price or above, and the order is going to get executed. Now, we have a thing called slobs over bliss. What is that? SL or BS over, and over is the market price, over buy limit, sell stop. Slobs over bliss. Sell limit, buy stop orders are entered above the market. Buy limit, sell stop orders are entered below the market. The left side, buy limit, sell limit, do not require a trigger. They're executed if it's a buy limit, it's executed at or below the price. If it's a sell limit, it is executed at or above. The right side of that, the sell stop and the buy stop and the sell stop do require a trigger. So now let's talk about stop order. So I enter an order to buy 100 shares of XYZ at 20 stop. So if it's a buy stop, slobs over bliss, buy stop, it's above the market. When the stock trades at 20, that triggers the order, and I buy it at the next market price, wherever that is. That could be above 20, could be below 20, could be wherever, could be at 20, doesn't matter. So a buy stop order triggers at the price above the market, it's above the market, triggers at the price, and then whatever the next market order price is, that's where I execute it. Sell stop is the opposite, it's below the market. So it trades down, triggers at the price. So sell 100 shares of XYZ at 12 stop. If it trades and hits 12 or lower, that triggers the order. And then the next price, market order, up, down, in between is where I do it. Now, next, what you probably realize from that is like, okay, hey, Mike, what if I want to, I don't, what if the stock triggers at 15 and then it's a buy stop and it doesn't execute till 25 because that's the next price, which is a little crazy, but you never know. And the answer is okay. So what you want to do then is you're going to put a stop limit on this. Okay. So now you're going to have buy 100. So let's say you're on a buy stop order. Stock's trading at $15. But if it trades to 20, you're going to buy stock. You want to buy it if you want it. And the reason usually being that you're protecting a short order or there's a technical analysis that's happened that it's a breakout spot. Okay. So you're saying buy me 100 shares of XYZ at 20 stop, and then you put limit 23. What does that mean? So I buy the 100 shares. If it goes to 20, that triggers the order, which becomes a market order. But you're saying, okay, I'm okay as long as it's below 23. If I'm putting a limit on this, so I'm putting a stop limit. Buy 100 shares at 20, stop, limit 23 once it gets triggered. Now, the other one is if it says buy 100 shares XYZ 20, stop, limit, that means that 20 is the trigger and the limit. So in that case, it triggers at 20, but then it becomes a limit order at 20, which of course means you got to buy it below 20. That way you don't get caught up in a tsunami of stop orders that take a stock up, way higher than it was. And just as a side story, there was a very prominent specialist in a very prominent stock that used to rate back in the late 90s, big internet stock, and he would actually gather stop orders in like millions of shares, so that what would happen is it would hit a stop order trigger, drop down 5 points. Specialists would buy the stock, and then the stock would go back up, and he'd be making money. But he would literally be gathering those stop orders to create a big gap. So it does happen. So that's why we put stop limit orders. The stop triggers it, the limit protects us. A day order. What is a day order? That just means that it's got to be executed by the end of the day. Okay. So at 4 o'clock close, order's done. And a couple different reasons for that are that they want to re-enter the order the next day. They want to look at what happened in the market. Another reason could be as simple as if you have a. So in my career, I never did a discretionary order, and I'll tell you the kind of orders I'd get. I'd get like buy 250,000 shares of Lucky Stores whenever you think is right. Um, buy a million shares of Rite Aid right after the opening. Sounds incredibly discretionary, but it's not. Why? Because discretion is asset, amount, action. Action, buy or sell. Asset, whatever the stock or bond is. And amount, how much did you do? Time and price is not discretionary. Okay, the time and price is not discretionary on any order. But if you hold the order past 1 day, past day order, that does become discretionary. And then lastly, we have good till cancel orders, which are orders that, so let's say I know I like XYZ stock. I want to buy it, but it's trading too high right now, too rich for my blood, as they would say, right? So it's trading at 30. So I'm going to enter an order to buy 100 shares of XYZ at 15, good till cancel. That means that goes on and on. As a matter of fact, it really goes into perpetuity, but they do check them every 6 months. So it stays filled, it stays open until it's filled or it manually cancels. That is a GTC order. Okay, now we're going to talk about the key regulatory bodies that regulate the securities industry. The first one we're going to this is who regulates you. If you become a registered rep, these are the people who are looking out to make sure you do the right thing. All right. So first one is SEC. SEC, Securities Exchange Commission, is a federal agency. This is daddy or mommy. Okay. They oversee everything from a 10,000-foot view. They administrate all the federal security laws. They oversee FINRA and national exchanges, and their job is to help promote fair and orderly markets and promote capital, raising capital. They do not revoke licenses directly. FINRA does that and then but what they do is if you're going to be charged criminally where you might go to jail, then SEC is involved. Next, we have the self-regulatory organizations. What does that mean? The SROs are organizations that are they have some government powers. They have the power to audit. They have the power to do punitive actions, but they are. I would call the SEC. If you remember back in the day, the SEC is the principal, and they are also literally a government agency. FINRA is like the vice principal. Remember, you could always tell the vice principal from the principal because the vice principal had sneakers on. He had a suit on, but he had sneakers on because he had to go running after everybody. I don't know if that's still a true thing, but that certainly was when I was a kid. All right. So FINRA is a self-regulatory organization. They actually came out of there used to be the NYSE and NASDAQ had their own separate regulatory arms. They combined about 20 years ago. It was about the same time that the exchanges became privately held. Um, so it's not a government agency. They regulate broker dealers and register reps. They do the day-to-day work, right? They register you. They make sure, they do the auditing. They do whatever the grunt work is to keep everybody in line. They enforce the rules. They examine the audits, and they're overseen by the SEC. They do have, like we said, they do get some near government power though. MSRB, same idea. But here's the deal. The MSRB makes the rules for municipal securities, but they don't enforce their own rules. Crazy, right? If a broker dealer breaks rules on the municipal side, then the SEC or FINRA comes in to enforce it. If a bank breaks rules on MSRB, on the Municipal Securities Board, then the Fed or the FDIC or the Office of Controller comes in to enforce the rules. So MSRB makes the rules for municipal securities, but they do not enforce their own rules. Next, we have the Fed. Very important. Fed makes monetary policy. What does that mean? They control how much liquidity is in the liquidity money wise is in the economy. The government, being, let's say, the president and the legislature, make fiscal policy. That's tariffs and taxes and such. Okay, but the Fed controls monetary policy, and they have a couple different ways that they do it. One of the ways is the overnight. They control the discount rate. So the discount rate is the rate that banks, which have reserve requirements, use to borrow money from the Fed overnight. Okay. The Fed fund rate, which is a similar situation. So the Fed fund rate is what banks use to borrow from each other overnight. The discount rate is what banks, if they can't find a bank to borrow from overnight, then they actually go to the Fed and borrow. Now, what this reserve is that when the Federal Reserve demands that banks keep a certain amount of reserve in overnight. And if the economy is rocking, if it's really hot, they're going to raise that reserve because they don't want so much money in the market. If the economy's not doing well, they may lower that reserve so that more money can come into the market. When we're talking about loosening money or tightening money, what we're talking about is the Fed is giving the banks more cash, and they have a couple different ways that they do it. One of them was that they set a lower Federal Reserve overnight reserve or higher. The other one is they give now they've never done this, but Reg T means how much money a broker dealer can loan to a customer, and right now that number is 50%. So if you wanted to buy $10,000 worth of stock, you can borrow $5,000 from a broker dealer to do it. In theory, they can make that go up or down. So if they wanted to tighten them, if things were so hot and inflation was too high, then they could raise that margin, or in theory, they could lower it. The Fed's main goal is two things: keep unemployment low, not zero, but low, and keep inflation at a reasonable level, which they believe, I think right now is about 2%. Okay, that's what they're trying to do. They regulate the amount of credit in securities. And by the way, the Fed is independent of the US government. It's basically kind of considered the US bank. In general, the way this rolls, now, you've probably read some of the crazy stuff with the going back and forth between the White House and the Fed, but here is economic policy, economic theory that's been in play for, as long as we can say. When the economy is hot, you raise the interest rates to slow it down so you don't have crazy rampant inflation. When the economy is going down, then you lower interest rates to free up more money so the banks can lend more money, and people are more willing to borrow money and hopefully expand their business. Next, we have the OCC. The OCC is the daddy of options. Remember, SEC is daddy of stocks and bonds and basically every federal security law. But OCC is a clearinghouse for options. Options only really became standardized in 1975, and they were always kind of the Wild West, right? So the OCC comes in and they literally do almost everything they regulate and clear the option contracts. They set the standard contracts, okay? They guarantee the performance of both sides. If somebody falls down on an options contract, the OCC steps in and takes care of it, okay? They act as a counterparty to every option trade. That's in essence what's going on, is that they step in to make sure that it always, they don't want to have any issues with options. And if you know about options, it's quick, it's big, it's a lot of money, fast, you could lose a lot. There can't be errors in options. There can't be default errors in options. Also, the OCC issues what's called the ODD. Anytime you open an option account for a customer, the first thing you have to do is give them the ODD, which is the option disclosure document, which basically says, like, you could lose it all, kid. These are really risky. You need to be pretty sophisticated to do this. You don't have to have them sign it, but you have to show that to the customer. And lastly, what we have is what the state. This is the NASAA, or what we call the US Act, the USA Act. This is the state admin for state level securities. So the states are sort of the daddy of the states. But just so we know, SEC always rules over states. Okay, if push comes to shove, SEC wins on that. That used to be different. It used to be equal, but the NISMIA rule in 1995, I think it was when they finally said, look, SEC trumps goes over state regulation. So what do states do? They regulate intrastate securities. By the way, when you think of like intrastate versus intrastate is within one state. Think of like when you were in college or in high school and you played intramurals. That was within your school. Intramurals, intercollegiate would have been when you, or intersecondary is when you play other high schools or other. So intra is states only. Inter is multiple states. And as I said, we call this the blue sky laws, regulated by the USA. NASAA is a national organization similar to like the FINRA for that, the FINRA for the states. Okay, now let's look at the different acts that come up. There's a bazillion acts, okay, but these are the ones that come up on the test. And if you notice, a lot of them are from the 30s. So what happened is in 1929, the market crashed. And, the pre 1929 market was basically the Wild West. Brokers could do anything they wanted, people ripping each other off, or as the brokers would say, the good old days. Back, kidding, of course. Back then though, it was, people who knew were insiders at the market were just killing the public with IPOs. They do pool investments. They would run up stocks to short them and then let them collapse, pump and dump. All the rules that you see come from that time. And I will say now, this is the other thing I've learned over my time on Wall Street. There is not one rule that's proactive. Any rule you see, people like to see this test and they're like, I don't want to do this. What the hell does that have to do with anything? I can tell you for sure that every single rule on this test is something that had been abused, not once, but to ad nauseum, to the point they were forced to make the rule. Broker dealers and government don't want to make rules. They want to do that laissez-faire BS, right? That Ayn Rand let it fly kind of crap, right? But the best capitalism is always going to be regulated capitalism, right? Regulated capitalism is the world that we live in. That has been for 60, 70 years that kept us out of a depression, and now actually going on 100 years, although it's starting to get a little unregulated. But these are the regulatory part. So what happened in 1933-ish? They finally decided that, okay, 25% of the population's out of work. Market crashed 90%. Market literally lost 90% of its value. Um, and they finally said, yeah, we probably need to make some rules to bring confidence back into the markets. Okay. So they did what we call the Pecora Commission. And the Pecora Commission, and honestly, they always say the John Kennedy's father, was the one who led that commission. And the reason he was so good at leading it is he was one of the big guys making all the money in the 20s. I mean, he was one of the wolves. So they had to get the wolf to come in to show them what was going on. So he had a big hand in making a lot of these regulations. So the first one we look at is called the Paper Act, the Securities Act of 1933. This is the primary market regulatory regulation. What is the difference between a primary market and a secondary market? Primary market, the issuer gets the money. Who's the issuer? Either the government, municipals or treasuries, or a company. The issuer is an entity that needs to raise capital to enhance or continue with their operation. The primary market regulates the issues that go there. If the issuer is getting the money, that's Securities Act of 1933. Prospectuses for new offerings. So basically, what used to happen is there used to be new offerings going out, and nobody knew what was in them. You just had to, take a recommendation of what could be a pretty unscrupulous broker. We've seen those movies from the 20s, so we know what they those guys look pretty sneaky. And it prohibits fraud and new securities issues. So that's the Securities Act of 1933. Securities Act of 1934 regulates the secondary market, the exchanges, the broker dealers, insider trading, basically be the fraud that happens after the primary market, the general everyday trading kind of fraud. Also, interestingly, the SEC was not created until 1934. Totally testable, by the way. SEC was not created until 1934 because I figured these guys wanted to screw around for one more year before. So they created the rules in 33, but then didn't actually create the police enforcement until 34. That's the way it rolls, right? So the secondary market created the SEC, governs brokers, dealers, exchanges, insider trading, secondary market, and created reporting requirements for public companies. In other words, so the 1933 Act made them come out with prospectuses for IPOs. So you had to show what your actual financial situation was as a company before you could go public. And then there had to be continued reporting requirements, right? So if you remember, the 10Q is a quarterly unaudited report, but then every year, every public company must do a fully audited 10K with the SEC. 1940, we have the down. Look here. This is one of those like FINRA things. Like, why do you make it so hard? Like that sounds like the same thing. It's like the same word being the same action needs three words. Or the words or something from the 1930s. It just FINRA. It just they're ball busters. What can you say, right? So 1940 Investment Company Act of 1940 controls that. This governs ETFs, closed-end funds, open-end funds, basically pooled money, pooled investments. Um, those used to be, and again, all these rules, if you see a rule, you can be sure that this thing was violated and ripping people off in the hundreds of millions or whatever dollars were appropriate in the 30s. The Investment Company Act is about investment companies. Don't mix that up with the Investment Advisor Act of 1940, which is investment advisors. Now, the difference between investment advisors and BDs is investment advisors give advice and get paid a fee to give the advice. Broker dealers execute orders and get commissions. And then in 1970, we had the SIPA, which created the SIPC. What is that? That is that if you're with the broker dealer and they collapse financially. Now, this does not protect you from market, like if you make a bad decision buying a stock or a bond or market conditions. That's not what it protects you from. It protects you from if your broker dealer collapses, like they default, they go financial. The SIPC covers up to $500,000 per account in securities, of which $250,000 can be cash. So now let's talk about some key registration exemptions. So these four up here are basically ways to not that you don't have to register with the SEC. And these are primarily about pre-public offerings or small public offerings. So let's talk about the first one, Reg D. This is private placement. So think of this like this is like, the Silicon Valley boys who are like they build a little company in the garage, they get tier one financing, tier two financing, which tier one's their mom, tier two's their dad, and then they actually find VCs or private equities that start to fund them. So what they're doing at that point is they're not public companies, they're private, and they're selling shares though to accredited investors without SEC registration. What is an accredited investor? An accredited investor is somebody who has a net worth of $1 million, including but it doesn't include their primary home. Liquid net income of $200,000 a year for an individual, 300,000 for a couple, and it has to have happened for the past 2 years and expected to continue into the future. These securities on Regulation D are restricted. So what does that mean? They can't just be freely sold. There's rules that we'll talk about with Rule 144. We're going to get into that part, but just remember, this is this is Regulation D, private placement, Silicon Valley type things. Now, this rule here, very important, Rule 506B. 506B allows Regulation D products to be sold to non-accredited, up to 35 non-accredited investors, but you can't charge them the commission. Okay. 35 non-accredited but sophisticated investors, up to 35. Above 35, you got to be SEC registered. Next one, Reg A. I can't tell you how many people take this test, get a Reg A, and go like, I never heard of Reg A. Nothing. Nobody ever said anything about Reg A. So now we're saying it. Okay. Reg A are small dollar offerings, kind of mini IPOs. So it doesn't sound like it, but tier one, $20 million raised in 12 months. That's a tier one Reg A. It doesn't sound like a small amount, but it is. Tier two is 75 million in 12 months. So the little IPO. But now here's a kicker with tier two. It's really a bizarre rule, crazy rule. If it's a tier two, okay, then you are required, and you're a non-accredited investor, you can't put more than 10% of your net income or 10% of your net worth into it. For whatever reason, tier one, they just let it fly. Whatever you want to do, you can do. But with tier two, you can't put in more than 10% of your net worth or 10% of your income if you're a non-accredited investor, also called as a mini IPO. Offering circular required, simplified prospectus. Rule 144. This is a biggie. So Rule 144 is a couple different types of stocks. So the first one is restricted stock. Restricted stock is stock that you have acquired pre-IPO. This is before the stock has gone public. You've gotten it, and you must hold for 6 months before you can resell, no matter what. Then we have control stock. Control stock is stock that goes to affiliates. That means somebody who works for a broker dealer or for the firm or is a shareholder of over 10%. That's control stock. If you have control stock, whether you bought it pre-IPO or post, when you sell it, you have to do the dribble rule, which is the greater of 1% outstanding or 4 weeks trading volume, and you can only do it 4 times a year. Now, if you have restricted stock, so you got a pre-IPO and you're a control stock person, then you have both. You got to hold it for 6 months, and you've got to do the 1% or greater of 1% or 4 weeks average trading volume. One of the ones it doesn't apply to, if you're selling less than 5,000 shares of $50,000 in 3 months, that's fine. You can just go do that. Anything else, you have to follow these rules. Rule 144A. There's a thing called quibs, okay? A quib is a big institution that runs over $100 million, and they have $100 million in investable assets. They do not have to worry about the Rule 144. And what does that mean? So, they don't want Vanguard. If Vanguard has a position, or BlackRock, or a big institution, they don't want them to have to actually, they're trading, okay? They can sell it when they want to sell it. They don't have those shackles. So a quib, which is a qualified institutional buyer, institution with 100 million or more, they're providing liquidity. They provide liquidity for private placement investors without public registration, but they do not have a holding period, and they do not have a dribble level either. Okay, next we're going to talk about anti-money laundering. Anti-money laundering, AML. And by the way, record keeping wise, 5 years. Okay. All three of these levels are 5 years record keeping. All right. There's three stages to money laundering. What is money laundering? Money laundering is that if you have, I don't know if you ever watched the Netflix series Ozark, great, great, scary, limited series about money laundering and how it works, right? So basically what happens is if money is acquired in an illegal manner or a non-ethical manner, pretty much illegal, that money to become spendable to go into banks has to be laundered through clean money, right? So if you had dirty money that you got through drug sales or through or whatever it is that you got it through, um, that cash has to run through a legit business or a legit amount of money, and then it comes out the other end, what we call clean. So we have three levels of anti-money laundering, and it's I go PLI, ply. That's the order, right? Placement. That's introducing the dirty money into the financial system, right? So you would that's you. If you remember in Breaking Bad, they owned a car wash, right? So the money from his illicit meth sales had to wash through the car wash, and they would just exaggerate the amount of money. Like a car wash would be super detailing all the other stuff, like $190 for a car wash that should have been $10. So they would do that receipt, and then they would put that dirty money into the cash register, and that would be introducing the dirty money into the financial system. Next would be the layering, which is disguising the trail through complex transactions, right? So when you see multiple LLCs, money's flying all around the world, different things, it becomes untraceable. That's layering, disguising the trail through complex transactions. And then integration, that's the last part. Now the funds, once they've been cleaned and laundered, they've been introduced to the financial system. They've been taken around from LLC to around the world, back and forth. And now integration is literally you're able to spend that money. You could put it in the bank. You're now legit. So we also have within that now, if you are a compliance officer, you have to report suspected anti-money laundering, right? So the first thing we look at is CTRs, a currency transaction report. What this is that if somebody in this Form 104, although I don't think they're going to ask you that part, the currency transaction report is if somebody puts in more than $10,000 in cash in a day into an account, you're supposed to report it to FinCEN. FinCEN is a financial crimes enforcement network. They're basically the enforcement network that stops for all AML compliance, and bank secrecy laws are also that's called BSA. BSA reporting requirements, and so bank secrecy requirements, and obviously with us, it's mostly BDs and IA reporting. So if somebody puts more than $10,000 in a day into an account in cash, that needs to be reported as a currency transaction report. Whether it's legit or not, doesn't matter. Still have to do it. Next, suspicious activity report. Anything over $5,000 has to be reported. So let's say that, you're getting somebody that you suspect to be a terrorist is running money through an account, especially if you see they keep running it and taking it out and nothing's happening, or they're not investing it in ways that look common. You have to report that, and you have to report that within 30 days. The CTR, by the way, needs to be reported within 15 days. Lastly, we have structuring or smurfing. This is where somebody tries to put in, I put in 2,000 and I put in 3,000, I put in 7,000 a day. So it looks like I made smaller deposits, but at the end of the day, it was still more than $10,000. So when you open an account, and this goes back to the Patriot Act, this all came up right after World Trade Center, after the 9/11. They'd said from now on, because some of the terrorists used some accounts to move money around, right? So they said from here on forward, when you want to open an account, you have to get four things no matter what: the name, date of birth, address, and ID number, Social Security or TIN. Okay. You cannot do business with somebody. You cannot open an account unless you get those. And the way you verify them is through a credit bureau. Now, what they're going to do is they ask you, oh, how do you verify the information from a customer? Do you use the IRS base? You do the FBI base, credit bureau? We don't have the FBI base. We don't have the IRS base. Okay. Now, so we can only do it through the credit bureau, and that's how you verify who people are through the credit bureau. And again, all anti-money law must be kept for 5 years. So just to go back to this CIP, because it does come up a lot, right? You have to get the name, date of birth, address, and the social security or TIN number. Cannot be a PO box. This just lets you open an account to take non-solicited orders. If you want to take solicited orders, you have to get more information. You have to get you have to find out what their finances are. You have to find out what their investment objective is. You have to get more information from them. But to do the basic unsolicited order, name, date of birth, social security or TIN, and an address. Next thing we're going to talk about is insider trading. So, interestingly, all these insider trading rules, or most of them, I was directly affected by them when I first came up in the business. So I started in June 1st of 19. I had a long story where I was a runner for a broker dealer for a while, and I played baseball and softball for them, and that's kind of how I knew guys. But my first day on a trading desk, actually being in the front line, was a day that a guy named Dennis Levine got indicted for insider trading, which turned into the biggest insider trading scandal pretty much in the history of Wall Street. And what it was is this isn't a risk arb days, a takeover go days of the 80s, where people knew, if you knew a company's getting taken over and that information was all over the place. So a stock could be trading at $30 in the morning and the night before, but you found out they're getting taken over. It might be trading at 100 the next day. So you can see where there was a lot of money to be made. But this is why it was illegal. And again, remember what I said, all these rules, they exist for a reason. Somebody broke these rules in size many times. This isn't about one rule being broken once. This is when it gets so bad they have to fix it. Okay, so now insider trading, the illegal use of public information. What's that mean? Trading on material non-public information. Now, material information, the definition of material information is, does it affect your investment decision? Okay, material information is, does it affect your investment decision? So some material information is what we do for a living, right? We're trying to talk people into, assets and buying things. And we're going to make a story that tells them, the reason they should invest in something. That's fine. The problem is if you tell them material non-public information, you're the CEO of a pharmacy and you know that you're about to get an approval from on a drug, but nobody knows that yet, right? You go tell somebody that, you got a problem if they act. So this is where we get into the non-material information with significant impact on stock price would influence your investment decision. Who's an insider? Officers, directors, anybody with information, right? And here's the deal: the tippy and the tipper can be held responsible. So if you're the guy who tells somebody inside information and they go do it, you're in as much trouble as they are. And by the way, even if they lose money, you still got a problem. Insider trading is insider trading. And what are the penalties? $5 million per charge for individuals, $25 million for a firm, up to 20 years in prison per charge. Now, nobody's getting people have paid those fines, but I think back even in the 80s, a couple people went to jail for 2 or 3 years. That was it. There was some crazy stuff that happened. Like one of the guys who was a prominent risk arbitrageur, John Mulhern, and Ivan. So he was about to go kill one of the guys who he thought ratted him out. They caught him, back in New Jersey. They caught him with all his guns. And if you remember the name Ivan Boesky, that was the guy who was that was my first time I learned, like, be careful idolizing people because a lot of times it turns out that it turns the other way. And Ivan Boesky was like the risk arbitrageur, the stories where he only sleeps 3 hours a night. He drinks coffee all day long. He's got all these idiosyncrasies. And then at the end of the day, it turned out he was cheating. He just was an insider trader. It's almost like I remember the other story I remember like that was when I was studying my Series 7, Actually, it might have been the one. It might have been series 14. Um, Bernie Madoff was listed in the study material as the prominent, groundbreaking, market making third market trader. And this guy was the president of NASDAQ at one point. Okay. Bernie Madoff. Bernie Madoff wound up having the biggest Ponzi scheme in the history of America by 20 times the last one. Right. And for those of you who don't know, Bernie Madoff wound up, if you don't know, I mean, it's almost a generic bad, like Bernie Madoff's the name of, bad investors or crooked investing. So this same guy who wound up being known as the most crooked investor ever was actually popped up as a as the Nasdaq president and the guy who started third market trading. It's if you work long enough on Wall Street or in this business, you're going to run across these kind of situations. It's not. Don't judge a book by its cover. All right, next. These are the prohibited practices. So churning, what is churning? Excess trading in an account. Okay. But a lot of it depends on the investment objective, right? If it's a little old lady from Iowa, yeah, that's churning. If you're trading too much just for commission, that's no good. But if the guy or girl's objective is day trading, maybe you're not excessive trading, right? So they determine it by investment objective. Painting the tape. Basically, painting the tape is putting up false trades to make it look like activity. Like maybe on the floor, or add two guys upstairs, two big traders start saying, "Hey, look, let's make it look like something's happening here." And by the way, this is some Wolf of Wall Street BS, right? Like you're trying to make it look active when there's nothing. All right, I'll buy 100,000 shares from you. You sell 100,000 shares to me, then sell me back a million. I'll buy a million, and really, there's no trade going on. But across the tape, it looks like there's a lot of activity. That's painting the tape. Breakpoint sales. This is from open-end mutual funds. Okay, open-end mutual funds, if you have a class A open-end front-end load mutual fund, and they usually have breakpoints where if you put in 20,000, you get a 7% charge. If you put in 30, you get a 6% and so on. Where if you get below 20, you got to pay the full 8.5%. But you can, so let's say you had $15,000 to put in an open-end fund and the breakpoint was 20. Okay. You're actually allowed to, you are allowed to promise pay the other 5,000 over the next 13 months. Now, if your registered rep doesn't tell you that you're allowed to do that, that is considered a breakpoint sale and it is illegal. Market manipulation, creating false, misleading market activity, very similar to painting the tape, but it's more along these lines. Like a market maker or a specialist on the New York Stock Exchange gets an order, and he gets an order to buy and an order to sell market. So instead of executing those two together, he puts himself in the middle. So he has the seller sell it to him lower, then he sells it back to the buyer higher. Right. So he takes two orders that were market orders that should have just been put together, and he manipulates them so he can make money. Front running. Front running is literally getting ahead of an order. I'm sitting on a desk and a guy gets an order to buy 200,000 shares. I know that stock's going up. I go grab 1,000 for myself. Or front running. I work at a firm that's putting out a positive research report today. I go and secretly buy 1,000 shares for myself because I know it's going to make the stock go up. Wash sale. Wash sale is selling at a loss and buying it back within 30 days. This is a little complicated. Basically, what's happening is if you sell at a capital loss, so let's say you had a stock that you bought at $50 and then you turned around at the end of the year and you sold it at 30. That's a capital loss of $20, which you should be able to take against your income tax. Okay. But if you buy that stock back within 30 days, that loss is negated. Okay. And what happens is you wind up getting a cost basis based on your new price. So another side story when December every year used to be fantastic because what would happen is all of my customers would check out, would look for all their losses, and basically I would sell and buy whatever their entire position was. And we'd go to the specialist, and what the rule used to be was as long as you're at risk of the market. Well, at risk of the market is I can sell 1 million shares. If the specialist buys it and then we wait 10 seconds and then I buy them back, I've now wrote both sides of that ticket. But that's when they decided finally said, no, that's not the way it's got to work. Is that from now on, if you sell at a loss, but you buy it back and if you buy it back either in stock or a call, like an option or anything that is like buying it back, that capital loss is negated. Now, what you do wind up getting is you get that capital, you get that capital that cost basis changes, so that helps you, but you don't get the money that you don't get the loss that you thought. Selling away. All right, what is selling away? Selling away is I work for another firm and I do business for them. And here is the dick. You are allowed to do that. All right. So let's say I work for Merrill Lynch. I got a buddy at JP Morgan and he asked me to help him out with something. I got, all right, I'll help you out. If I just help him out, I got to tell my firm. Okay. If I get paid, I have to get written authorization. So selling away. I work for another firm. If I just do some work for somebody, I just got to let my firm know. If I get paid, I've got to get written approval. And now unauthorized trading, basically executing trades without permission from the customer. You don't have discretion, but you're out there doing trades for them completely on. Come back here. Eh. Yeah. Okay. Okay, here is the last slide that I'm going to do for this SIE setup. And I'm sorry there's a little pause there before. Hopefully you guys found me back here. This is about investor protection programs. So just quickly, we have SIPC. This is SIPC is about if you have a brokerage account that fails. Again, this does not protect you against bad investments. This protects you against this only protects you against the a broker dealer defaulting, falling down. Okay, and the way it works is you get for if you have an account up to $500,000 in securities, totally protected. Out of that 500, if two, they'll protect up to 250 in cash. So SIPC is $500,000 in securities, and up to 250 that can be in cash. FDIC are banks. Okay, so bank, and by the way, this is per account. Okay, per account. Banks are $250,000 per account. This is a bank. If a bank fails, it's $250,000 per account per depositor. Okay, so if you have a individual account and you have a joint account and then your kids each have account, each one of them gets covered for $250,000. But if you have an individual and then you have another one in your same name, that limits yours only to $250,000. Um, Again, this is market losses do not count. Commodity futures not covered. Okay. Investment contracts and unregistered investment contracts not covered. This is about owning stocks and owning assets. So this is the last screen of the day. This is the last screen of the series. And this is just some quick SIE formulas that might help you out. If you know them, it's not going to hurt you. That is for sure. Do I think that you have them? Probably not for the SIE, more so for the seven, but not going to kill you to have them, right? So you might even want to take a screenshot of this. So this is current yield is annual interest divided by market price. NAV, remember NAV from open-end shares, total assets minus limited shares outstanding. On options, and again, there's not a lot of option questions, okay? But a break even on a call, strike price plus premium. Break even on a put, strike price plus premium. Intrinsic value. Again, intrinsic value, and this will be, I'm going to do an option video that's going to be mostly a simple options kind of thing, and I'll cover some of this stuff. But intrinsic value is market price minus strike price, and intrinsic value on a put is strike price minus market price. Reg T is always 50% of the purchase, done by the Federal Reserve. Long market equity is market value, market value minus debit balance equals long market equity. Short market is credit value minus market. I'm probably going to do a little bit of that on the margin side. Maintenance call. I don't ever think you even have to worry about this at all for the SIC, to be honest with you. Quick memory rules. Discount bond, coupon, current yield, yield to maturity, yield to call, right? That's the order. If it's a discount bond, those yields are going down. Those yields are going up. Coupon, current yield, yield to maturity, yield to call. Country version, nominal, current yield, yield to maturity, yield to call. If it's a premium bond, same order. Coupon, current yield, yield to maturity, yield to call. But those yields are going down then. And hip hop version, coupon, current yield, yield to maturity, yield to call. Country version, nominal, current yield, yield to maturity, yield to call. If the bond is above par, those yields are going down. If the bond is below par, those yields are going up. When bond prices go up, rates go down. When bond prices go up, rates go down. And also long and low. Remember, I'm going to leave you on that one. That's going to be the end of this series. Long and low. Okay. Long and low is the longer the bond, the more volatile the interest rates, the more volatile the bond. And then the lower the coupon, the more volatile. So if you have two bonds the same year, lowest coupon is most volatile. If you have a discount bond versus a premium, discount bond is more volatile because lower coupons are more volatile. And with that, that is the end of this series. Like I said, I'm going to do a side edition of Slobs and Bliss and options and probably some margin stuff just to have it in there. But in essence, if you know what we've gone over the last 3 hours of me doing these tapes, you're going to be in pretty good shape for the SIE. Um, we recommend achievable content with Kaplan QBank. That's been the best thing that we have seen that I've noticed. I think has worked for people in the SIE. Might be a little different with the other tests because the questions might not be hard enough. For or with achievable, it's a little trickier with the seven. We'll have that discussion when we have that discussion. Um, and as always, my website is buttonwoodtutor.com. If you need help with tutoring, private or semi-group, I'm always around to help out with that. And also, you can purchase Achievable on my website. If you go to study plans, there's a discount, I think, of 10% or something, or I don't know exactly how much it is, but there's a discount to buy Achievable. And other than that, I will see you next at the Series 6 or 7 or 63. That's my next set of videos coming up. But I thank you very much for listening and take care, everybody.